Hi everyone, I'm Emily from Grad Student Finances. This video covers your options for paying taxes on your grad student stipend throughout the year and is great for first-year students, students who are switching funding sources, and anyone who's confused about grad student taxes. The information in this video is intended for domestic U.S. graduate students.
A very important note is that I am not a professional tax preparer and I'm not providing legal or tax advice. I'm a former graduate student who has devoted time to reading the tax code and matching it with my personal experience and the experiences of other grad students. This information is current as of tax year 2015. I hope that the concept of paying taxes on your grad student stipend does not shock you. Prior to the 1980s, grad student stipends were not taxed. However, today, as a very rough guide, anything you receive above your qualified education expenses might become part of your taxable income for the year. Even if you have taxable income, you might not end up paying anything in income tax if your income is low enough or you have enough credits and deductions. If you're not sure whether or not you'll need to file a tax return, you can take a quiz on the IRS website, which is linked in the video caption. It also wouldn't hurt to do a formal calculation of whether and how much you might owe in tax using Publication 505 Worksheet 2.1, which I will go through in detail later in this video. From this point forward, I will assume that you will owe some income tax on your stipend. The questions we will address are whether you are required to send tax payments to the IRS throughout the year, and if so, how you can or should accomplish this. I will focus on federal income taxes in this video, but don't forget about your state and local income taxes as well, if applicable. One important thing to understand about taxes is that the IRS expects to receive tax payments throughout the year, not necessarily just in April. Grad students can accomplish this in one of two ways. The first option is to have taxes withheld from your stipend. Instead of receiving your full income every pay period, you will receive your paycheck after federal and state taxes have been taken out. With this method, your taxes are being paid automatically throughout the year. You can set up withholding through your departmental or university payroll system. Students receiving compensatory pay will be able to have taxes withheld. Students receiving non-compensatory pay may or may not be able to have taxes withheld. If you're not sure what kind of pay you're receiving, see the video linked in the caption for an explanation or ask your payroll representative. All you need to do is fill out and submit a W-4 for your federal taxes and the corresponding form for your state taxes. This is what a W-4 looks like. You just enter some basic information about yourself and your family. The state withholding form will be similar. After you submit the forms, you will have taxes withheld from your paycheck in approximately the correct amount. The second option is to pay your taxes manually, either every quarter or yearly by April 15th. If you don't have taxes withheld, you may have a responsibility to file quarterly estimated tax. You can calculate whether you have to file quarterly by essentially doing a high-level draft of your taxes using Publication 505 Worksheet 2.1. I'll show you an example of how to fill out Worksheet 2.1 for a hypothetical person with stipend income. This person is single, not claimed as a dependent on another tax return, and has a simple overall tax situation. This worksheet will estimate how much tax the person will owe at the end of the year, which will tell her whether or not she needs to pay quarterly estimated tax. Of course, when you fill out Worksheet 2.1, you will use the numbers that are specific to your own situation and for the correct tax year. You can find a link to Publication 505 in the video caption. In this example, the person has $24,000 of stipend income during the calendar year, which is entered in line 1. Line 2 is for the person's deductions, either the standard deduction of $6,300 or a larger amount of itemized deductions. Line 3 is line 1 minus line 2. The person in this example is single with no dependents and is not claimed as a dependent on anyone else's return, so she has one exemption which is worth $4,000. Line 5 is line 3 minus line 4 and is the amount of income that will be taxed. Line 6 is the amount of tax this person owes. I looked up $13,700 in the 2015 tax schedule and found the amount of tax owed to be $1,593.75. You can find a link to the 2015 tax schedule in the video caption. This person has a very simple tax return with no extra taxes or credits, so the $1,593.75 is just passed down the worksheet through line 13C. Line 14A says to multiply line 13C by 90%, which is $1,434.38. Line 14B asks for the total amount of tax paid in the previous year. I'll say that this person had a slight cost of living raise in her stipend over last year and enter $1,570 as the total amount of tax paid last year. I take the smaller of the two amounts to line 14C, which is 90% of this year's tax owed, $1,434.38. Obviously, if the amount of tax you paid last year is less than 90% of the amount you expect to pay this year, you would move forward with last year's tax figure. This person had 0 taxes withheld from her stipend, so she expects to owe the full $1,593.75 on April 15th. In the meantime, she is responsible for sending the IRS $1,434.38, line 16A. Because the amount of tax this person expects to owe at the end of the year is more than $1,000, this person is required to make quarterly estimated tax payments by sending to the IRS 1/4 of the total estimated tax every 3 months. If the amount of tax calculated had been less than $1,000, she wouldn't have to pay tax quarterly, but rather in one lump sum at the end of the year. On April 15th, July 15th, October 15th, and January 15th, this person will send in a quarterly tax payment of $358.59. She'll make up the last 10% of the tax due, plus or minus any adjustments, by the following April 15th when she files her tax return. Publication 505 also has this helpful flowchart to determine if you have to pay quarterly estimated tax. The extra information to notice here is that you can only use 100% of your previous year's tax as the amount you're responsible for paying throughout the year if that amount of tax is from 12 months of income. If you are responsible for paying quarterly estimated tax, as the person in my example was, use the vouchers in Form 1040-ES to send in your payments. The worksheet in Form 1040-ES is the same as Worksheet 2.1 in Publication 505. If you fail to send in your estimated tax payments, you may owe a small fine on April 15th. Even if you are not responsible for paying quarterly estimated tax, you should still prepare to pay your tax bill on April 15th. One way to do this is by setting up your own withholding system. Use Worksheet 2.1 to calculate the total amount of tax you will owe, then set 1/12 of that amount aside from each of your monthly paychecks. Then, pay the full amount of money you owe by April 15th along with your tax return. Don't forget to go through a similar calculation process for your state taxes. It's possible that you will have to send quarterly estimated tax payments to your state as well as the federal government. There are advantages to each of these payment options. Option 1 is less work. You fill out a couple of short forms one time and you will have taxes withheld from your paycheck perhaps for the rest of the time you are at your university. If you ever need to make adjustments to your withholding, you can just file another set of forms. Option 2, however, gives you more control over the amount of tax you're paying throughout the year. You can avoid over-withholding and receiving a tax refund by only paying as much as you are required to through your estimated tax payments. I have a few last notes for first-year graduate students. The example I gave before is likely for an older graduate student who paid a full year of taxes on her stipend the previous year. In your first year of graduate school, your taxes may be somewhat different from how they will be in later years. If you had a full-time job before starting grad school, you probably had taxes withheld from your paycheck, and you will have to factor into Worksheet 2.1 both your higher income and your tax withholding from the earlier part of the year. Conversely, if you did not have a full-time job before starting grad school, your income is likely to be quite low for the calendar year, so you may not owe any income tax on your income in that first semester. You also have to watch out in your calculation for whether or not someone else is claiming you as a dependent. If your parents, for example, claim you as a dependent, you cannot take a personal exemption on your own taxes, and there may be other tax repercussions as well. You can work through all of these variables as you fill out Worksheet 2.1. Whatever your tax situation in your first semester of grad school, though, be sure to redo Worksheet 2.1 in January to help you prepare tax-wise for your first full year of receiving a stipend.
Thank you for watching this video, and I hope it helped you to understand your options for paying your taxes throughout the year. I personally have had taxes withheld and had to pay quarterly estimated tax at different points in my training, and I much prefer tax withholding, so I hope that's an option for you. If you have any further questions about tax withholding or quarterly estimated tax, please leave a comment or email me at emily@gradstudentfinances.org. I would also love if you would ask me any questions you have about personal finance for graduate students. See you next time!